as the question that was Matteus said, that kind of which one is the trust in the system. Is it the governments that there's a lack of trust, or central banks? I totally agree. Obviously, this is not black and white. This is not kind of things are right, things are wrong, kind of. But this is a up to debate. But in this specific question, kind of, I agree with Samsa, who answered that central banks are meant to be objective and free of politics. This is not certainly not true currently. So, as I suggested, central banks, as we will see in the next couple of minutes, central banks have been forced to become major players in economy, more so than they have been in the past. And is there a way out for them? Remains to be seen. What I mean forced is that central banks have had no other option than to push interest rates down by this massive quantitative easing program. So that means that they have been buying massive amounts of different bonds, government bonds, also corporate bonds. Say Japanese central bank is buying shares, Swiss central bank is buying company shares as well. So as central banks can buy anything, is it really the role of central banks to buy different assets? Historically has not been. They can do it. Is it good or bad? Why they do it is mostly kind of they keep the economy going. They push the interest rates lower. The short-term interest rates have been even negative for some time now in Europe, which is not usual thing. So they have become kind of major players in today's economy, and you could say that we have become the market. We have become addicted to this central banking activity. How do we get out of this? Good news first is that, okay, this is not the first time that we are facing challenges. Think different wars, different depressions we have had. We have had techno boom, which is marked there as I suggested. The Black Monday, 87, I was a student there. The market went down by more than 20% in a day. These things happen. It's only natural that these things happen. Recessions happen, but luckily we have always recovered and reached higher level than where we were in the past. So that is good news. This is not the end of the world. As Warren Buffett, in his letter to his shareholders in 2013, wrote that, of course, then 2013, things in the US were kind of a bit uncertain. There was a lot of uncertainty in the air. He wrote that, of course, immediate future is uncertain. America's faced unknown since 1776. So since the whole USA was formed in its current form. So these things happen. See, future, you can never forecast the future at 100% probability, not even 90% probability. Future, the nature of future is uncertain and should be so. Euro crisis, this was a big thing in Europe. This kind of continuation of the previous picture about risk premiums. Just think of this for a second. In 2011, the Greece government bond yield was at a level of above 30%. So, in other words, Greek government, the financing costs was 30%. Obviously, no country can pay and should even try to pay 30% interest costs. That was kind of sky high, too high. investors recognized that Greece cannot serve their debt, and then it defaulted. Plus there was something called LTRO. We'll come back to these terms, long-term refinancing operations. This is what when central bank, the Fed, sorry, not Fed, the European Central Bank, now we're in Europe, so they started one of their operations that they still continue kind of executing, long-term refinancing operations. That led to interest rates, the risk premiums kind of go down. OMT was another tool that they used, outright monetary transactions kind of, they also said that we start acquiring government bonds. Mario Draghi, who then was the chairman of European Central Bank, he's famous, whatever it takes, was well taken by the market. Draghi said that no matter what it takes, whatever it takes, the European Central Bank will help for the European financial market to cope with any risks. And essentially they started this European version of a quantitative easing program, which is called OMT. And as investors learned that there will be this big brother, so European Central Bank, which will be buying the bonds. So the prices of these bonds starts going up, and while the bond prices go up, the yields go down, and we have seen a very rapid decrease in the risk premiums from 2011 to 2013, 14 or so. So we have avoided this existential risk in Europe that risk premiums would stay on the level of 30%. Then COVID hit, another risk that hit the market. This is totally different, totally obvious, totally different. Banking crisis was from the banking sector. Euro crisis was from excessively leveraged European companies, kind of, especially Greece and some other southern European countries, having too much debt to refinance those. Different source of risk. COVID, totally different risk, but of course this influenced also the financial markets. What happened was that the market prices collapsed massively. What makes this interesting, why I took this specific picture, was that if you think of, now we are living 2020, we are living 2020 end of January, World Health Organization declared the coronavirus outbreak an international public health emergency, but the financial market, stock market didn't care. So it only took until end of February when the financial market said, okay, now this really hits us as well. So it's not only kind of Chinese virus that doesn't influence kind of Americans or Europeans or any other nations. We recognize, and then the stock market collapsed heavily. But continue with the good news is that this is a Purchasing Managers Index, PMI index, and why I like this way of illustrating this as JP Morgan does it. I find this fascinating as they do illustrate the kind of the positive optimism in manufacturing kind of companies with green red, with light green, and red illustrates kind of the pessimism. So whenever this index is clearly less than 50, so they mark these with red. So we can see that 2008-9, almost the whole world was kind of on red. So that was a very risky, very kind of bad, challenging market in many means. As I said, this was a global financial crisis. 2011-12, this was a European crisis, France, Italy, Spain. This was also felt by industrial companies, not only kind of the governments, but we recovered. Then in Brazil, there were some country-specific challenges have been obviously kind of and will be felt every now and then. But overall, the market has been recovering pretty well. Then the COVID hit, but this has been kind of, from companies' perspective, relatively quickly we have recovered from this. This is from 2021, last year already in August. Japan is still kind of suffering a bit, but overall kind of companies have recovered very well from this COVID crisis as well. So companies have been doing well. Company shares, the share prices are all-time highs here and there. So market has recovered very well. So these are the good news. Then not so good news. I'm not saying bad news, but not so good news. Before you become excessively optimistic about the whole economic world, so remember that the reason we have recovered from this recent COVID crisis, it was a global, massive thing, but economically we have recovered, you could say, surprisingly well, thanks to different stimulus packages. There's been fiscal stimulus packages and monetary stimulus packages. So fiscal stimulus, so governments have borrowed money massively. Finland, as an example, 2020 we borrowed, was it more than 10 billion? This year we are budgeting something like, was it 6 billion or so. So that means that government is overspending relative to the revenues. Monetary stimulus, central banks have been actively kind of financing these operations. In the big picture, the most active has been US in terms of fiscal and monetary stimulus. Globally, this is from 2020 only, when the crisis hit in the early 2000s until December. Cumulatively, the global stimulus packages can be estimated to be something like 28 trillion. 28 trillion. Is a lot of money. How do you compare? Remember, global GDP is a bit more than 90 billion. So just to highlight the magnitude of these stimulus packages, so as it said here, 33%. So that is it's a massive amount of stimulus packages that have been used to tackle this COVID crisis. And obviously that it doesn't come without a cost. So that has led to debt levels of countries increase. In the US, only the current the federal debt level is almost kind of close to 100%. And this is the current official forecast for the future, is that it will go in 2050, it would approach 200%. If nothing, no revisions will be made. This is to show kind of this is the debt levels as such. This is the role to highlight the role of the central bank, the Fed. And just look at this picture for a while. This is Fed's balance sheet relative to the GDP of America. So historically, in the Second World War, it was something like 10%. GFC, which is Great Financial Crisis, 2008. So it jumped to the higher level than where it has ever been. Here we see. So in short, so the central bank's balance sheet has grown to first 15%, and now as a result of this COVID to 40%, almost more than 40%. So never ever in history this has been tried that central bank becomes clearly the major financier of US economy. So historically, central banks have played very important role, but their role has been to say set the interest rate, the short-term interest rates, higher or lower reference rate. Now they have become a major acquirer of the bonds as well. It's not only US. This shows from the financial crisis 2009. Securities purchased by major central banks. Fed there is on the bottom. They have acquired until last year already something like almost 10 trillion worth of bonds. Same has happened in Japan. Same has happened in Europe. So relative roughly 20 trillion worth of bonds have been acquired by central banks, and still remember the GDP globally is something like 90 trillion. So massive operations. The size of central banks relative to GDP, Japan is on the level of its own. They own more than kind of 100% of bonds worth more than the GDP of Japan. This is kind of how can that continue? It seems to continue year after year. But also we can see that historically these levels were close to zero. But now they have been approaching Japan here, but also Europe, Fed approaching 60, 70, 80%. So this has never ever in history been tried. So I cannot tell you how this will end. Another not so good news is that as a result of these interventions, the global debt levels have increased. This is from IMF. They use also kind of BIS and IIF data as a background. So global debt has reached a level of something like 300 trillion. Another 300 trillion, the same as was the size of the global financial intermediaries overall. And this relative to the GDP is 360%. So this is bigger than it. This is more than it ever has been. So we have a lot of debt. This includes both government debts, corporate debts, and household debts. Reinhard Rogoff, this time is different book, suggests that whenever very rough number that they are citing every now and then was that when a country's debt relative to GDP exceeds 100%, so that leads to some kind of challenges. Slower economic growth first could lead to defaults. Whatever, 100% is a lot. The same applies to corporate debt. The corporate debt kind of exceeds 90 or 100%, has historically led to some kind of difficulty. The same for household debt. Now, if you look at all these two combined, so globally, aggregate level, all these three segments are above 100%, leading to 350 or 60. So this could be a bit, could say, worrisome. Why this is different? As if you look at this Reinhard Rogoff's book, kind of book's picture that we took a look at a bit earlier. South American countries, they do default every now and then. Some Asian countries, say Soviet Union, Russia, defaults every now and then. Has defaulted. There was a Asian-Russian crisis in 1998. Many countries did default. That's when the Russian banking crisis also hit a few banks went bankrupt. What is different now is that these mature markets, so that means America, Europe, Japan, these countries are growing their debt faster than these emerging markets. So this is something that has never happened before. And this leads to kind of very interesting kind of a situation. Another picture kind of showing the role of central banks globally. In the US, this was in 2020 already. The Fed owned 22% of the public debt. In Japan, 43%. Europe is shown here. So central banks are the biggest owners of public debt in different parts of the world. And this has led to Howard Marks, who is the founder of hedge fund Oaktree, or asset manager Oaktree. He said, it's pretty good kind of take a while to think of this, as he says that markets work best when participants have a healthy fear of loss. And now the central banks have become and started buying everything. So you could say that the risk seems to have disappeared. And this is not healthy in the long run. So central banks, they do operations that some may criticize. Of course, their intention is good, but there are some, you could say, unintended consequences. For example, now as in times of COVID, central banks have been massive buyers of bonds, government bonds, corporate bonds, not only investment grade bonds, but also kind of junk bonds. Even shares, some central banks have been buying. So that has led to a feeling among investors that we can buy anything because the central bank will help us anyway if there is some risk that we'll face. So you could say that has led to excessive risk-taking in financial markets. And now this is at the core when we'll discuss about the role of central banks in a couple of weeks' time. As one example, which is pretty well kind of highlights how unhealthy the current financial situation is. Just one example. This is the Greek government debt. And here I highlight the picture that you kind of, we already took a look at earlier. The Greek government debt, you see this, my pointer. Here's the yield of the 10-year government bond. It peaked almost 35%. This is something that we saw in 2011, 2012. At that time, the debt relative to GDP was 180%. So market participants recognize that this is simply too high. No country, okay, believe in Reinhard Rogoff or not, but kind of no country can serve a debt which is 180% relative to GDP. So we are no longer willing to lend money for Greece unless it offers us 30% yield. That was kind of the market situation in 2011-12. Then what happened was that they defaulted. And this decrease here shows that from 180, when the country defaulted worth of 100 billion, so the debt relative to GDP went low to the level of 140. Okay, that's pretty high still, but then we had the central banks, Draghi's, whatever it takes, saying and all these outright monetary kind of transactions, quantitative easing programs and so on. So the market kind of was settled. Okay, this is something that what happened. Now look at what has happened over the past 10 years. This is the debt level kind of went down here, but it has now become back 180, and now it's above 200. So Greece government has been spending money every year more and more, and now the COVID crisis has led to a jump in this government kind of consumption to above 200%. What has happened in the government bond yield? It has went down to 1%. So how can this be? So of course it cannot happen, it cannot be by any other reason than the market knowing that European Central Bank will buy these bonds no matter what. So what you can say that obviously these bond yields they clearly do not reflect the riskiness of a Greek government as the debt relative to GDP is above 200%. So this unhealthy, never heard of, never seen situations this current central bank policy has led to. Kristalina Georgieva, who is the IMF chief, last year said that a few kind of challenges or a few points that she would like to make. The first one is that the interests have been low for long. It has led to firms and governments being able to borrow cheaper than what they otherwise should be. So the terms have been too attractive to borrow. The second thing is that because of low interest rates, banks are less profitable. We'll talk about bank profitability next week's Thursday. So banking profitability has been very low. And the third one is that non-banking financial intermediaries are not sufficiently regulated. These are the non-banks or shadow banks that will have a separate topic kind of dedicated in a few weeks' time. Key takeaways from today. We have recovered pretty well from 2008, 11, and now 20, the COVID. But the fiscal and monetary stimulus packages have been massive ever since 2008. Debt levels are historically high, and especially mature markets. So this is new. And central banks are driver's seat. They have kept buying these bonds. So they keep the interest rates on the very low level. And this has led to never before seen kind of risk-reward ratios, such as one example is this Greek government bond example. Any questions, comments from today's lecture? Or are we able to go back to the questions that I suggested that we should be able to answer after today's lecture? The first question, why we still keep talking about kind of 2007-8? You see, the environment that we are living currently stems from how the global financial crisis hit the market in 2007-8, the role of central banks. Why we can't predict financial crises is it's not only mathematics, it's not only facts, it's about kind of animal spirits, it's about politics, it's about official truth. So that what makes forecasting financial crises is kind of so interesting, so challenging. Now, how has the role of central banks changed over the recent 40 years? Massively. Central banks have become major buyers of different assets, government bonds, corporate bonds, other assets, mortgage bonds as well. And that has led to a situation where when central banks are so deeply involved in owning these different asset classes that has led to interest rates being kind of very low for very long time, and governments, households, corporates kind of borrowing more and more. So from how to move from this on, it will be very challenging, and we can't take a look. We can learn from the past because this has never been tried before. But still, at the end of the day, the kind of think that this is very tricky as a situation. as Warren Buffett reminds you, kind of world is tricky. You can't forecast future, how this will be kind of evolve. We'll see, but this is not the end of the world. Any questions, comments concerning this? I once more advise you to take to watch Inside Job movie before next week's Tuesday. Mikko Au will come with us, and after he leaves, we'll discuss about the movie and the lessons. Greenspan will be mentioned there. Many kind of Chuck Prince is mentioned in the movie, and many other characters that we have been talking yet, and we'll talk kind of in the future. How do you think this should be fixed? As a question is that it cannot be sustainable to keep the economy afloat with central banks indefinitely. How do you think this abnormal situation should be fixed? That is it's not $1 million question. It is, I don't know, it's $1 trillion question. There are no easy fixes. And something that the more you think about this, and the more you think about how the central bank's role has been in the past. So I'm pretty sure that central bankers, they wouldn't like to be in the position that they are currently, because they are on the driver's seat currently, as you can see. It's very difficult to see how central banks would be taking steps back and become kind of agents, the players in the market that they used to be in the past. So very difficult to see that happening. Now, why these raising interest rates and kind of tapering questions that are being we'll discuss about these later, why they are so in the news is that, of course, if central banks start tapering, meaning that they start buying first, they lower the pace of buying bonds. At some point, they stop buying them at all. And even at some time, the idea is that they start selling these, or they let the bonds that they own to expire and do not buy new ones. So as the debt levels are so high, so somebody must come and take central bank's role. And it's very difficult to see who that would be. So I can't see how central banks would kind of have this luxury of taking steps back. But I'm not criticizing central banks. They have saved the economies kind of over the past 14 years. And it's good to remind you that kind of they have no other option. Politicians who have not let them not to act. So they have been forced to act indirectly. Whenever these the packages, say whatever it terms or quantitative easing programs have been developed, and crisis packages have been developed, as in Euro crisis, those packages have been developed or masterminded kind of in a very short time period, typically over the weekend. So the crisis has hit in the market on a Friday or Thursday, and that some solutions have been needed by Monday morning when the market starts operating. And luckily, something has been, so these decision makers have been innovative enough to figure out some structures, such as the default of Greece, the central bank's operations. But it would be too much to expect that over those weekends, somebody had time to think about the long-term consequences of these short-term solutions. So there have been solutions that have satisfied the market in the short run. But in the long run, this is where we are. And nobody can have a clue. Of course, one could be that we let the inflation kind of, as the nominal interest rates are very low currently, inflation is 6-7%. So that means that the real interest rate rates are -6, -7. So you can say that the longer we can absorb this or continue like this, so kind of the nominal values of these excessive debts will become less serious or manageable, become more manageable. The challenge there is that central banks have a policy, they have a mandate to keep the inflation close to 2%. And so formally, they cannot let the inflation to run at the rate of 7% for many years. That would be against their mandate. That has to do with the role of central banks overall. That has to do with the mandate of central banks. Something that has to do with the mandate of central banks is this green finance, that is the topic of the term paper. Highly interesting kind of as a case, which is not directly mentioned in the mandate, and how central banks should be operating. That is something that we'll discuss separately. As now we come to the trust question. As central banks have a mandate, and as long as inflation has been around 2% or even lower, so we have had a good reason to trust in the system as such, in central banks. Now, if they let the inflation to be 7% for a long time, there will be risk that some investors, some politicians no longer trust central bank. And trust is the most clearly most important asset that central banks do have. And trust is something that they can't lose. They cannot afford to lose that trust. Now I see it kind of take me some time to take a look at your question. Politicians need to make difficult structural painful. Yeah, that is at the core. So politicians should, in an ideal world, they should start making decisions which make governments kind of deficits smaller, meaning that they should start raising taxes, or they should start deducting the costs. And those are politically kind of challenging, or could say suicidal. It's kind of as voters like the way that we have been, as I said, we have become addicted to the central banking money. So that is why this situation is so, I'd say, kind of challenging, but mostly interesting. This is the most interesting time I remember kind of being in financial markets. Do you see countries like Greece or Italy even reducing debt? Currently, the debt of Greece is 200%. Italy is 160, 170. For example, by returning to growth and stability pact. If you ask this is just an opinion, I don't know. But I find it very difficult to see why a country would, because that would mean that the country should kind of start, as there's this Maastricht Treaty, which is politically it was accepted when Euro was adopted, that no one Euro country can have debt relative to GDP more than 60%, 60. And if you look at currently, there are countries which have 200%, 160%, even Italy, which is the third largest European Union country, 160%. Of course, they can never reach the 60%. So it's totally unrealistic to even talk about that. So we have even decreasing that would mean that kind of countries would start saving money and pay their debtors. So politically, if I was a politician, so even though I prefer kind of strict financial policy, I see that kind of to be re-elected, I would be irrational in even trying to do that. So it would be very difficult for me to see how countries would be able to lower their debt levels. The way to go kind of solve this is would have to GDP growing, and as long as the GDP growth would exceed the growth in the debt, so this would in a longer term, this would be solvable, but it will take long time. of course, that would be the optimal. That would be the optimal, that we find growth path in Europe, that we can grow out of these excessive debt levels, which is possible. Is it probable? That is another question. And for that also we need that there will be the investments, growth investments in Europe being taken. Partly that is being kind of, those need to be financed, that needs kind of risk capital, and that is why we come to the European kind of capital markets union as one theme, which is a topic of next week's Thursday. The aim is good. The tools are there also, but it's not that easy kind of to solve. There are no quick fixes. So challenging environment for central bankers and especially for politicians, for sure. Okay, good questions, good comments. We are pretty much kind of ending today. It's approaching kind of 3 o'clock. Next Tuesday, kind of watch Inside Job Movie and take a look at the slides that Mikko sent us. They are downloaded there, and see you then on next week's Tuesday at 1:15. Cheers.